Getting pre-approved for a mortgage is the first and biggest milestone when it comes to buying your first home. But most home buyers don't realize that getting a pre-approval for a mortgage doesn't mean you're free to do whatever you want with your finances now. There are some huge mistakes that 99% of home buyers don't even realize that they're making after getting pre-approved for a home loan. And while some of these things might seem silly or might seem like very small things, they can actually cost you thousands of dollars, the home of your dreams, and even set you back years before you're ready to buy a home again. And so in this video, I'm going to share with you the 5 biggest mistakes that I've seen homebuyers make over the years so that you can avoid making them if you're trying to buy a home this year. Now, to start, this is probably the most common and probably the most obvious on this list. For whatever reason, when people get approved for any kind of credit, they start going on this kind of credit approval spree. It's not really that much of a surprise that the biggest mistake that most first-time homebuyers make after getting pre-approved for a mortgage is starting to apply and get approved for other lines of credit. Now, while it might not seem like that big of a deal to get approved for credit cards, especially if you're not going to be putting any money on it right away, when it comes to your pre-approval, this is actually a huge deal for a number of reasons. The first and most obvious one is the impact that additional credit cards can have to your credit score. A lot of first-time homebuyer programs have very strict requirements on what your credit score needs to be in order to qualify for them. And so if you've been pre-approved for one of these programs, opening additional credit can actually lower your credit score even if you don't put anything on those credit cards. And this doesn't just apply to credit cards. Any kind of installment loan, like an auto loan or even an auto lease, can make a huge difference as well. Not only is your credit score a big factor when it comes to your pre-approval, but probably even bigger than that is your debt to income ratio. You see, when you're getting pre-approved for a mortgage, you're not really getting pre-approved for a maximum price, but rather a maximum monthly payment based on your debt to income ratio. And as a refresher, all the debt to income ratio is your new monthly mortgage payment plus the minimum monthly payments of your debts divided by your gross or pre-tax income. And so when it comes to opening different credit cards or auto loans, a little definitely goes a long way in decreasing your purchasing power. As a rule of thumb, every $60 a month in debt that you add on is $10,000 less of buying power for your new home. So as you can imagine, a $600 a month car payment could be as much as $100,000 less that you could get pre-approved for. So it goes without saying that the number one thing that you want to avoid is opening up or adding new debts to your credit report. But adding debt to your credit report isn't the only thing that you should be looking out for. Now, it might sound crazy and actually counterintuitive, but you actually want to completely avoid paying off any credit cards or auto loans after you've been pre-approved. I know that I just said every $600 a month in debt is about $100,000 in buying power. So you might hear that and say, well, I'm gonna go pay off $600 a month in debt so I can get an additional $100,000 in buying power. But believe it or not, that's actually a huge mistake if you're doing it wrong. You see, what most people don't realize is when you're paying off debt, there's a wrong way to go about it. One of the most common mistakes that I see when people are paying off debt, especially things like credit cards, is they'll pay off a credit card because they think that they're helping, and then they'll close that credit card so they don't spend any more money on it. But by closing your credit card, that actually does more harm than good. You see, when you close any kind of credit account, it completely erases all the positive history that it's added to your credit report. So imagine that you had a credit card for the last 10 years and you had 100% on-time payments. That's a lot of positive history. But if you end up paying off and closing that credit card, it's like that never even happened. And so as a result, your credit score can have a huge dip, even though you did something that should have been a good thing to do. And the same thing goes for auto loans as well. I typically do not recommend paying off an auto loan before closing on your house because it can have a huge impact for your credit score. And I know this from personal experience. A few years ago, I paid off my auto loan, and for 3 months, my credit score had dipped from the 700s down to like the 680s. Now, after those few months were over, my credit score jumped right back up. But since I pretty much deleted the 4 years of positive history from my auto loan, the credit bureaus didn't really like that. Okay, but what are you supposed to do then if you want to pay off debts in order to get approved for a higher amount? Well, most people don't realize this, but you don't have to pay off your debt before closing on your home. In fact, the number one strategy that I recommend for home buyers to do is to pay your debts at closing. You can include the debts that you want to pay off in your closing funds on top of your down payment and closing costs. And so this way you can increase your purchasing power without decreasing your credit score. And this also makes sure that you're not paying off any debts before getting into the home that you actually want to. Now, there's one more huge mistake that home buyers make when it comes to their credit report that I've seen so often ruin their plans of buying a home and have set them back years before they can actually get qualified again. There's been so many times that I've seen people get excited about getting pre-approved. They share that news with their family, and then somebody comes out and says, hey, I've been trying to get pre-approved for something too. Can you help me by co-signing on this loan for me? And in the moment you're so excited, you're saying, absolutely, I'd be glad to help you co-sign for your new auto loan or whatever else that you're asking to be co-signed on. And while it might feel really great to help your friends or family get approved for a loan, this is the biggest thing that will set you back at least a year before you can get approved for a home loan. You see, even if you're not the one making the payments on the debt, if you're considered a co-signer, we have to count that debt against you. And the only way that we can ignore that debt is if the other person that you helped co-sign for has made at least 12 months of payments consecutively from their bank account. So that means them sending you the money every single month and you paying it from your bank account doesn't count. It has to be coming from their bank account, and you have to be able to get 12 months of bank statements in a row showing that they were the one that paid for it. And try as you might, this is the one mortgage guideline that there are no exceptions for. Now, other than lowering the amount of debt that you have in order to increase the amount that you can get pre-approved for, another thought that most people have is increasing their income so that they can qualify for more or make the house just a little bit more affordable. And for a lot of people, this means a major job change or starting a new job altogether. Now, while a career change might seem exciting and rewarding, this is probably one of the worst things that you can do once you've been pre-approved for a mortgage. At the same time, this is also probably the most misunderstood mortgage guideline out there. You probably might have heard that you need at least 2 years on the job in order to qualify for a mortgage. Now, and while that's technically true, you actually need 2 consecutive years in the same career path, not necessarily the same job. But there's some unique considerations as well. For example, if you're in the same career path and you're going from an hourly position to a 100% commission position, unfortunately, you're going to need at least 2 years in the commission role in order to qualify. The same goes from going from a salaried position to a variable hourly position. In that particular case, we often need at a minimum 12 months of history showing that you've had variable pay as opposed to a structured, steady salary or 40 hours a week. Other obvious job changes are big shifts in career. For example, if you're going from an education job to an engineering job, it's harder to make a straight line between those. However, if the job is in the same career path, but the industries are a little bit different, that can still work. For example, say going from an accounting firm that works with a dental practice to accounting for a marketing company. You're still doing accounting, you're an accountant, that's your position, but it's not necessarily in the same field. Those kinds of examples are okay. But overall, you want to be able to avoid job changes as much as possible. But what if there's no other way around it? What if you know that you've got a great job offer coming and you don't want to miss out on it, but you also still really want to buy a house? Well, as long as you're keeping those things consistent, right? The kind of position in the field that you're in and the basis of pay that you're going into, you can actually buy a home and get pre-approved for a home loan without being even on the job yet. As long as you have an offer letter from your new employer and it clearly states that your start date is before your first monthly payment, it shows your new rate of pay and the guaranteed amount of hours that you would have, that's actually an acceptable document when it comes to getting pre-approved. So don't think you have to sacrifice your dream job in order to get your dream home. Depending on how you structure it, you can probably get away with both. Now, we've talked a little bit about debts and we've talked about income, but what about saving up for a down payment? You might not have realized it, but the way that you save up for your down payment actually makes a huge difference. Now, it kind of sounds weird, but actually making really large deposits into your bank account that you're using for your down payment is actually a bit of a red flag and can make some major issues pop up when you're getting a pre-approval. A lot of times when saving up for a down payment, people will put that money out of their bank account so they don't touch it and leave it as cash. And once they're finally ready to buy a home and they've hit their savings goals, they deposit all that cash all at once into their bank account. And while it might not seem like that big of a deal, it's actually probably one of the most difficult things for us to deal with. As a general rule of thumb, any large deposits that are over $1,000 that aren't your usual paychecks will automatically get flagged for review. Now, the reason why is this goes into a little bit of money laundering and fraud situations, but ultimately any deposits that you're making that are that large, we have to source. And so making big cash deposits are often very hard to source because you have to prove where that cash is coming from. And you've been sitting on that cash for months, it becomes very difficult to prove that that cash didn't come from somewhere illegal. This also goes for big deposits from you selling something. A lot of times people will supplement their down payment funds by selling off big pieces of furniture or something else that they've had that was valuable. If you are going to be doing something like that, what you'll need is a bill of sale proving how much you sold it for, as well as making sure that it was sold for a comparative amount. One of the funnier stories that I've seen over the years when it comes to big deposits was a couple who was pre-approved for a mortgage and then got married shortly after. Well, they had a pretty big family that was pretty well off, and they ended up getting a bunch of deposits with between cash, Venmo, Zelle, Cash App, you name it, of thousands of dollars into their bank account, all within about a week. And so when that loan went to underwriting and we saw their bank statements, the underwriter had a lot of questions about where all this money was coming from and who was gifting them all of this money. And so in order to prove that these deposits were legitimate, we had to actually get the guest list from their wedding and actually show, hey, these people were at their wedding or they couldn't make it for whatever reason. They sent this money and that's where that's coming from. And so these little things that might not seem like that big of a deal ended up kind of biting them in the butt and caused some delays when it came to getting their loan approved. So when it comes to getting a mortgage and after you've been pre-approved for one, the best advice that I could give you is basically live the most boring financial life possible. If you can possibly avoid it, avoid spending any money on your credit cards, opening up new lines of credit, stay at the same job if you're able to, and definitely don't make any large deposits into any kind of bank account. But in the event that you have to do any of these things, coordinate with your mortgage lender first. An experienced loan officer will be able to let you know whether or not the things that you're planning on doing will be okay and how that'll actually affect your pre-approval overall. Oftentimes, if you're in a good enough financial position, there probably might not be anything wrong with financing a few extra $100 a month. But if your pre-approval is right on the edge, that could be the difference between you qualifying for your dream home or settling for a starter home instead. Or as I've shown in some of these examples, could set you back months, if not years before you're ready to buy a home again. And so my hope for you is that you take these experiences that I've seen with other clients and apply them to your knowledge once you've been pre-approved for a mortgage so that you can completely avoid making these mistakes altogether. Like I said, getting pre-approved for a mortgage is the first major milestone in the entire home buying process. So if you want some more tips and tricks on how you can actually go about that whole process, if you haven't even started that yet, check out this video here. It goes over some of my best tips and tricks that I've learned over the years to walk you through that process and make it incredibly easy. So if you haven't pre-approved, I wish you the best in your process, and I hope this helps you avoid some of these mistakes. And if you're getting ready to get pre-approved, I'll see you in this video next.